Investment history was made this year. You realize that, do you not? I cannot get over how many people are just like, oh my goodness, if the world collapses, all this is going to happen. Oh, if the markets fall off a cliff, all this is going to happen. As you are literally living through investment history. It's just amazing to me how many people they don't even realize what has just happened and will never happen again in our lifetimes. I just it's nuts to me. So oh man, let me share with you something here. So my man writes in, he goes, man, my American funds are getting crushed. Should I go ahead and sell them and move to something else? And I get this question all the time, and I just anyway, so we're just going to look at the Bond Fund of America starting at the end of this. Yeah, he's mostly talking about this fund because his other funds are being crushed just like everything else, which is just typical for stock funds. But he's like, oh my goodness. So anyway, so we got a high of 1354 and a low of 1095. So we're going to take our trusty calculator and we're going to do 13.54 minus 10.95. It's down 259 off 13.54. So it's down 19%. 19%. And of course, it's up now to 1139. So it's picked up a buck of that loss. But anyway, that's pretty significant. Down 19% in a bond fund. It's getting crushed like a stock fund. Yeah, because I'm going to show you, because history has been made. All right, so we're just going to look at this spreadsheet I have here. And I just literally took the 1-year rates off of Shiller's data from Yale, 1-year rates, and then Shiller for some reason stops right here at 2012. I'm not sure why. So I just had to add the rates from 2012 until today. And this is what we got. Now this, ignoramuses would say, look at that, oh my goodness, look how high the rates were. Oh my goodness, we got crushed. That's inflation, that killed the economy, blah, blah, blah. Yeah, all right, well, this is not logged. I cannot stress, I'll go into this here in just a second. It just says here we are in 1873, the rates are 8.35. At the end of the Depression, they were 0.63, and that's a pretty significant decline. It went from 0.63 in 1942 to 17.63 in 1981, all right? And then it went back down to 10 basis points in 2021, up to basically 4.76 now. That in itself doesn't seem remarkable. It seems like a big drop, a big run-up, a big drop. Let me show you something here. We can go to this, we can go to Edit Chart. We're going to go down to here to, I think we got to go to Customize. And I think we got to go to Vertical Axis. Right there. Watch this. This is log scale. All right, so let me explain again what log scale means, because it's critically important. All right, so an increase in rates from 1 to 2 equals 100%. Everybody agrees with that. An increase in rates from 1 to 2 is 100%. An increase in rates from 2 to 3 is 50%, right? Yeah, is 50%. An increase in rates from 3 to 4 is 33%, all right? All right, so this right here, they all increase by 1, but the percentage from the starting point is significantly lower as you went down, as interest rates went up. All right, so the increase from 1 to 2 is a doubling of your interest rates. The increase of 2 to 3 is a halving of your interest rates. The increase of 3 to 4 is a 1/3 increase of your interest rates. All those are 1% increase, but the percentages of increase, which is frankly what really matters here, where we were before, where we are now. The actual percentages are what matters. And if you think about it, like what the markets do yesterday, they're up like 700 points. If you're up 700 points when the Dow was trading at 1,000, that is a 70% increase. That's huge. If you're up 700 points when the Dow is trading at 30,000, it's not nearly as beneficial to you, because all that matters is your dollar bills. The actual increases are relevant relative to the percentages, because that's what matters. I hope this makes sense. So the increase of 1 to 2 is a significantly more increase than 2 to 3, which is significantly more than 3 to 4. Never mind 4 to 5 and whatnot. All right. So what we do is we log these, because the log says the increase from 1 to 2 is the same as the increase from 2 to 4. All right, so, oh boy, I don't have my, I gotta get, so 1 to 2 is a 100% increase. 2 to 4 is a 100% increase. 4 to 8 is a 100% increase. The percentages are what matters, not the actual amount, is the percentages. I hope that makes sense. So what a log scale does is says, look, man, we were down to 50 basis points right here. Yeah, I think I saw 50 someplace. Whatever. Right there, 0.56 in 1940. It went all the way up to 17.3 over the course of 41 flipping years. All right, so we have, so we got one log right here. This is a doubling, 0.5 to 1. Then 1 to 2, right there. And I wish it actually, I wonder if we can change it to make it, well, whatever. We'll just keep with this. All right, so 1 to 2 is another doubling. So we went from 1 to 2 over the course of 1940 to 1950 about. So over the course of 10 years, we doubled twice. We went from 0.5 to 1, then to 2. All right, everybody with me so far? Then we went to, by the time we got to 4%, it was right there, 1964. It took us 24 years to go from 0.5 to 1, 1 to 2, 2 to 4. 3 times. That's, again, if you look at it as inches, we went from 0.5 to 1 is 1 inch, 1 to 2 is 2 inches, 2 to 4 is 3 inches. I hope that makes sense. But it took, 24 years. Now we're at 4. When did we go to 8? We didn't get to 8 until about 1979. So it took 15 years to go to 8. So to go 4 inches, it took from 1940 to 1979. It took 39 years. And then we went from 8 to 16 basically in 1981. So from 1940 to 1981, we went 4 inches. We went from 0.5 to 1 to 2 to 4 to 8 to 16 over the course of basically a lifetime for many people, 2 generations. So we went from here, 2003, from 1.1 to 5. That's, that's reasonable. That's significant, but that's nothing compared to what we went from here. We went from 0.1, I mean, look at that, to 0.5. 0.1, 0.2 is a doubling. 0.4 is a doubling. That's like 2.5 inches. There's another inch. That's 3.5. Then I mean, look at that. I mean, the amount of the increase on top of the amount of the decline. This is the Great Recession, 5.34 to 0.12. 0.12. I mean, this is significant too. But I mean, look at that. I mean, this looks. I gotta see if I can't make it. I want to make it so. Hold on a second. I want to figure out how to do it better. But anyway, you can see right here, right, 10% essentially. It might be better to understand percentages. That's a 500% increase from 10 to 50%, if that makes sense. All right, that's I mean, that's 10 to 100 is a 10% increase in interest rates. Everybody understand that? 100 to 10,000 is another. 100 with, I'm not sure what that is. 100 to 500 is another 5% increase. 5% or five times increase. I hope that I'm probably butchering this, but anyway. Look, so even this right here is somewhat misleading. It went from 0.12 to 2.33. That's huge. But that's not anything when it went from 0.1 to 4.76. I mean, look at that. That's a doubling. This is right here. We've doubled what we were from. You see what I'm saying? Like 2.33 to 4.76. We've gone above it by 1 other inch, another doubling of where it was right there. Yeah. This is history being made. This will never happen again. To go from where we are now, let me just edit this and go back to get rid of the percentages, customize. I think I went to local access. If I did, yeah, right there. Go to there we go. Yeah, so to go from here I mean, from here to have the same increase, we'd have to go to 32% interest rates. I mean, so if you survive now, why? I mean, what more could you possibly sit there? I mean, this is a carnage like we've never seen before, and yet you survived it. I know it's so easy to say if the market falls off a cliff, the bond market has fallen off a cliff, and yet here you are today to live to tell about it. I hope that tells you something, man. Not only did the bond market fall off a cliff, but the stocks were down bear market too. And you're here to talk about it. Give yourself some credit. We are witnessing history is behind us now, and you survived. All right. Love your thoughts. We'll see you.